Welcome back to the quarterly call. All content is for informational purposes and is not investment advice. Please consult with an investment professional.
So today we're sitting down to really unpack quite a bit of documentation around a major global payments player. We're looking
Yeah.
at their Q3 2025 strategy, their performance updates.
Right.
And it's not just, quarterly numbers. It feels like we're exploring something bigger, a real transformation they're going through.
That's exactly it. The core theme that keeps coming up, both from management and what the numbers are starting to show, is acceleration.
Acceleration, okay.
Yeah, a definite acceleration towards specifically profitable growth. It really marks an inflection point, I think.
So when you say stronger, more disciplined, what's the tangible proof compared to, say, a couple of years back?
Well, look at the transaction margin dollars. If you exclude the interest they earn on customer balances, right?
Okay.
2 years ago, that metric was actually shrinking, negative growth. Now, they're casing for, 6% to 7% growth for the full year 2025? Wow, that's quite a swing, from negative to mid-single digits.
Exactly. It shows that their focus on quality volume, not just any volume, is really paying off.
Yeah.
It requires huge discipline, like you said.
And it's not just margin discipline, right? We've seen revenue growth pick up steam, too, over the last, 2 quarters?
Yeah, consistently. So you've got this combination of better execution hitting this inflection point.
Yeah.
And that's why people are really paying attention now.
And the bottom line reflects that confidence, too, I gather. What's the headline number there?
The big one is the non-GAAP EPS growth expectation for the year. They've guided that they're on track for at least 15% growth there.
15%. In this kind of environment, that's pretty punchy.
It really is. It signals they've managed to squeeze a lot of efficiency and scale out of the business, even with, the choppy macro conditions and competition.
Okay, so that leads into something else that really caught my eye. A big signal of maybe financial maturity. They're initiating a dividend.
Yes, that was a major announcement.
For a company that's always been about reinvesting for growth, is this the right time? Does it signal they're slowing down on growth?
I think it's highly symbolic, but also very calculated. It's a massive, tangible signal to the market, to shareholders, that management sees their cash flows as sustainable, as predictable.
Even while still funding growth.
Exactly. Even after funding those, aggressive growth plans, it really strengthens the whole capital return program, working alongside the share buybacks they're still doing.
So it's not replacing buybacks, it's adding another layer.
Precisely.
And how significant is the dividend itself? Is it a huge payout?
No, and that's key. It's extremely disciplined. It's calculated based on a pretty small 10% payout ratio relative to net income.
Only 10%.
Yeah. So it explicitly keeps their main priority intact.
Yeah.
Invest in growth first, then return capital in a, measured way.
And they have the firepower to do both.
They do. The balance sheet is exceptionally strong, high free cash flow generation. It gives them that flexibility. They can signal maturity with the dividend, but keep fueling the growth engines.
Okay, let's unpack that acceleration then. Beyond the EPS and the dividend, strategically, where's the momentum really coming from? You mentioned more balanced growth.
That's the strategic win here, the balance. For a while, growth felt a bit lopsided, maybe too reliant on one area. Now it's healthier, more distributed.
So like total payment volume, TPV, how did that look?
TPV accelerated. It hit 8% growth year over year, or 7% if you strip out currency effects. That's over $458 billion in volume.
Big numbers. But volume alone isn't everything, is it? Are the customers sticking around? Are they doing more?
That's the crucial question. And yes, the engagement story is strong. Monthly active accounts, well, they only grew about 2%. That might suggest some market saturation, sure. But transactions per active account, and this is key, excluding the sort of lower margin PST business that grew 5%.
Ah, so existing users are doing more stuff.
Exactly. They're integrating services like Venmo, like Buy Now, Pay Later, deeper into their daily financial lives. That depth, that stickiness, is way more valuable long-term than just getting a new user for one checkout.
And the company has this framework, right? These 4 strategic pillars they keep talking about to drive this quality growth. Can we quickly recap those?
Sure. It's their playbook, essentially. First, winning checkout online and increasingly in-store.
Right.
Second, scaling Omni and growing Venmo, really turning Venmo into a proper monetized platform, not just P2P.
Got it.
Third, driving PSP profitability, making their big enterprise processing arm actually contribute reliably to margins.
Okay, the less glamorous but huge volume part.
Exactly. And fourth, scaling next-gen growth vectors. This is the future stuff, agentic commerce, ads, things like that.
And they keep pointing to one specific metric, branded experiences TPV or BE-TPV. Why is that the bellwether for this whole transformation?
Because BETPV measures their success beyond just that online checkout button. It captures volume where their brand is explicitly chosen. So, yeah, traditional checkout, but also BNPL, Venmo transactions, debit card swipes.
Ah, so it's the true omnichannel measure.
Precisely. It reflects whether they're succeeding in being part of the entire customer journey, not just the final click. And BETPV grew 8% currency neutral in Q3, matching that overall TPV acceleration.
And it seems like the U.S. market is really where the strategy is hitting its stride first.
U.S. is the proof point, absolutely. U.S. BE volume growth accelerated sharply to 10% in Q3.
10% compared to what previously?
That's more than double the growth rate they had just a year ago.
Yeah.
It really validates this concept they call the flywheel effect.
Okay, the flywheel. Explain that. How does getting someone to use, say, their debit card in a coffee shop lead to triple the revenue online? It seems counterintuitive.
It's about habituation and trust. When they get a customer using that debit card offline in the physical world, it fundamentally changes the relationship.
How so?
Well, the data is pretty stark. Customers who use the debit card transact almost 6 times more frequently overall.
6 times?
Yeah. And they generate nearly 3 times the average revenue per active account, the ARPA, compared to someone who only uses the online checkout button.
So they become holistic users.
Exactly. They start seeing the platform not just for online shopping, but for daily spending, money management. It makes the whole relationship stickier, more defensible across all channels. The flywheel kicks in.
That makes sense. But none of that works if the basic online checkout is clunky, right? Which brings us to that pay sheet redesign they've been working on. It sounds complicated.
It is massively complicated. This is the really hard technical grind of the transformation. They're untangling like a decade or more of legacy code, complex integrations.
Why is it taking so long? How far along are they?
Well, they've rolled out the new design to about 25% of global checkouts, which might not sound like a lot.
Doesn't seem fast, no.
But you have to remember, this is mission-critical infrastructure. Billions of transactions. You absolutely cannot break payments. So caution is paramount.
Okay, fair enough. But for that 25% where it is live, what's the impact? Is it actually improving things?
Oh, yeah. The data validates the effort. In the U.S., where they've optimized these cohorts, they're seeing close to a 1 percentage point improvement in conversion on average.
1 point. Across billions in volume, that adds up fast.
It translates into billions in extra volume for them and, crucially, higher sales for their merchants. It's a huge deal.
And it's not just the look of the pay sheet, right? They're also working on the friction points, like logging in.
Right. Friction kills conversion. So they're pushing hard on scaling biometric login, think passkeys, using the mobile app for one-touch authentication, anything to remove that password hurdle.
And getting merchants to show the payment option earlier.
Yeah, that's the upstream messaging piece, getting merchants to use their payment-ready APIs so the option appears prominently early in the journey, not just buried at the end.
So if you put it all together, the cleaner pay sheet and the easier login, what kind of conversion lift are they actually seeing?
That's where the synergy really kicks in. When they combine those efforts, the tests are showing conversion rate improvements anywhere from 2 percentage points up to 5 percentage points.
2 to 5%? That's massive in e-commerce.
It's a game changer. Huge for merchants and a major competitive edge in that checkout battleground.
Okay, let's shift gears to one of those growth engines, Venmo. For the longest time, it felt like this cool P2P app that didn't make much money.
Right. Great for splitting pizza money, but not much else for the bottom line.
But the strategy now positions it as this money movement platform for the next generation. Is it finally hitting that monetization stride?
I think it's clearly hit an inflection point. The scale is enormous, nearly 100 million total active accounts. That's huge reach, especially with younger, digitally savvy, often affluent users.
Okay, scale is one thing. Is it translating into actual profitable volume yet?
It is, and it's accelerating. Monthly active accounts, the MAAs, accelerated to 7% growth year over year. That's nearly 66 million monthly actives.
Better than the overall account growth.
Exactly. And TVC, the volume flowing through Venmo, grew 14% in Q3. That's the 4th straight quarter of acceleration.
14%. And are they actually making money from that volume?
Yes. The really critical piece, pay with Venmo, using it for commerce, not just P2P, hit a milestone. It crossed $1 billion in TPV in September alone.
$1 billion a month just from the commercial side.
That shows it's finally moving the needle beyond just social payments.
So what does that mean for Venmo's revenue contribution overall?
Venmo's on track to pull in about $1.7 billion in revenue this year, and that's excluding interest income.
$1.7 billion. And the growth rate?
Over 20% year-over-year growth. And importantly, that's a full 10-point acceleration compared to just 2 years ago.
10 points faster, so it's really kicking into gear.
It's moving from being, maybe a necessary cost center to being a real margin-accretive growth engine.
Now, here's what I found maybe the most interesting part in all the material. This huge gap, this monetization runway for Venmo. The current average revenue per monthly active, the ARPA, is only around $25.
Right, just over $25.
With nearly 100 million users. Why is that ARPA so low? Where's the disconnect?
It's all about the depth of usage. Over 90% of Venmo users are basically just using the free, low-margin P2P function, splitting bills, paying friends back.
Okay.
Only a tiny fraction, maybe 5% to 10%, are actually using the monetized features like the debit card or the Pay with Venmo button for shopping. And even fewer, less than 5%, use things like direct deposit to bring funds in.
So the vast majority are just surface-level users.
Exactly, which means the upside potential is enormous if they can convert them.
So explain the ARPA multiplier concept they talked about. How much more valuable is a multi-product user?
It's exponential. Management calls them multi-product users, people using P2P plus the debit card plus Pay with Venmo. For that group, the ARPA is about 4 times higher than the P2P only average.
4 times higher. Okay.
And then you get the super users, the ones who also bring their paycheck in via direct deposit, really using it like a primary financial account. Their ARPA is 6 times higher.
6 times. So converting just one P2P user to a full ecosystem user is like adding 5 or 6 new basic users in revenue terms?
Pretty much, yeah. It's a land and expand strategy focused entirely on deepening the relationship with the existing user base, not just chasing new signups.
That potential is staggering. But changing habits is hard. How are they actually getting people to use the debit card or set up direct deposit?
They're being much more strategic about incentivizing it, especially at sign-up and through targeted campaigns. New users now adopt the debit card at nearly 4 times the rate they did just 2 years ago.
4 times the rate. That shows the push is working.
Definitely. And in Q3 alone, they added 1 million first-time debit card users. Some of that was driven by specific partnerships, like with colleges, trying to capture that next generation early.
And they're moving into bigger ticket, more essential spending too, right? Like that Built partnership for rent payments?
Yes, the Built partnership is a fantastic example. Rent is usually a large, recurring payment. By letting users pay and split rent through Built using Venmo.
It anchors Venmo in their essential finances.
Exactly. It moves it beyond just discretionary social stuff into core, high-value spending. That's the kind of consistent volume you need to really drive those 6x ARPA multipliers. It positions Venmo almost as a bank replacement for some users.
Okay, growth engine number 2. Buy now, pay later, BNPL. This feels less like a feature and more like a fundamental shift in consumer credit, especially for younger demographics.
It absolutely is a generational shift, and they are definitely capturing a big slice of it. BNPL volume grew consistently over 20% again in Q3, particularly strong in the U.S., which is a very competitive market.
20% growth. That must put the scale of their BNPL operation pretty high now.
Oh, yeah. They're on pace to process close to $40 billion in BNPL TPV for 2025.
40 billion. And do customers actually like the product? What's the feedback?
The feedback seems very positive. They have a Net Promoter Score, an NPS, of 80 globally for BNPL. That's really high satisfaction. People seem to genuinely value the flexibility.
And they're expanding it too.
Yeah, expanding geographically into Canada recently, and expanding the product itself, offering longer terms, up to 24 installments in places like Italy and Spain, which helps for bigger purchases, and bringing it in-store in the U.S. via the mobile app.
What's the main strategic play with BNPL now? It seems like they're trying to change when people think about using it.
That's the core shift. Upstream presentment. Moving BNPL from being just another payment option you find buried in the digital wallet at the very end.
Something you see much earlier.
Exactly. Presenting it right on the product page or early in the shopping journey. Tapping into that immediate desire, I want this now, how can I pay over time?
Does showing it earlier actually work? Does it increase sales?
The tests show it does. When BNPL options are presented upstream, they saw on average nearly a 10% lift in their overall branded checkout volume.
10% lift just by showing it sooner.
Yeah. So it not only boosts BNPL usage itself, but it drives incremental sales for the merchant and makes the whole platform stickier.
With that kind of growth, nearly $40 billion in volume, how are they managing the risk? Isn't BNPL inherently risky?
That's a fair question, and one management addresses directly. They emphasize a balance sheet light model,
Meaning?
meaning, first, most of their volume is the short-term pay-in-4 product. The average time the loan is outstanding is only about 40 days.
Okay, so it turns over very quickly. Less long-term exposure.
Right. Very quick turnover minimizes that duration risk. And second, they're actively using external capital partners.
Like the recent deal with Blue Owl Capital.
Exactly. They externalized a chunk of their short-term U.S. receivables to Blue Owl. Critically, that deal was structured to be net neutral to their operating income in Q3.
So they offload some risk, free up capital, but keep the customer relationship and the fees.
That's the idea. They keep the customer, the merchant relationship, the transaction margin, but use partners to help fund the actual loan book. And importantly, BNPL continues to have that halo effect, driving 30% to 40% incremental usage of their core branded checkout. It pulls people deeper into the ecosystem.
All right, so we've covered the core acceleration, Venmo's monetization, the BNPL engine. Now let's look forward. The company talks about these 3 generational shifts they have to win. Digital wallets, BNPL, which we've discussed, and then agentic commerce.
Agentic commerce. Yeah, this is the big AI-driven future they're preparing for.
Explain that. What is agentic commerce?
It's the idea that increasingly you won't browse websites yourself. You'll tell an AI agent like ChatGPT or Google's AI or others what you want, and the agent will find it, maybe even decide on the best option and purchase it for you.
Okay, so the AI does the shopping. Where does a payments company fit in?
They want to be the essential plumbing, the trusted infrastructure underneath those AI interactions.
Yeah. And they're already making moves. I saw announcements about partnerships with Google, Perplexity, OpenAI.
Big multi-year partnerships.
Yeah.
Yes. The OpenAI one is fascinating.
Tell me about that. How does checkout work inside ChatGPT?
So imagine you're chatting with ChatGPT. It recommends, say, a specific pair of running shoes based on your needs, instead of sending you to a website.
You can buy it right there in the chat.
Exactly. Their branded checkout becomes the payment layer within the ChatGPT interface. For you, the shopper, it's seamless, trusted payment. For the merchant selling the shoes, they get paid instantly through an integration directly into that AI flow.
What gives them the confidence they can win this space? Why wouldn't merchants just build direct integrations with Google's AI, OpenAI, and every other AI model that pops up? Seems like that could cut out the middleman.
That's the potential threat. Absolutely. But their play is to be the indispensable orchestration layer.
Orchestration layer.
Think about it from the merchant's perspective. There won't be just one AI agent. There will be many Google, OpenAI, Perplexity, maybe others.
Yeah.
Does a merchant want to build and maintain separate complex integrations with every single one?
Probably not. Sounds like a nightmare.
Right. So the pitch is, integrate once with our agentic commerce services. We'll handle connecting you to consumers across all these different LLMs. We'll manage the identity, the fraud protection, seller protection, compliance, all of it.
Ah, so it's like a universal translator and security guard for merchants entering the AI world.
That's a good way to put it. It lets them scale into agentic commerce without the massive technical headache.
Okay, that's the merchant benefit. What about me, the consumer? Why do I want their wallet inside the AI rather than just giving my card details to the AI?
Trust and safety and buyer protection. When an AI buys something for you, it can feel a bit opaque. Using a known, trusted digital wallet gives you guarantees. You know you have fraud protection, dispute resolution.
And post-purchase stuff, like tracking, returns.
Exactly. All that crucial post-purchase support is managed through the familiar wallet interface, not scattered across different AI interactions. That's vital for consumer confidence, especially early on. And then there's the benefit for the LLMs themselves, the AI platforms.
What's in it for them?
Instant access to a massive, established ecosystem, building out a global network of tens of millions of merchants, plus the identity verification, fraud systems, global payment processing. That would take an AI company years and billions of dollars.
So partnering gives them instant commerce credibility and scale.
Precisely. It really is designed as a win-win-win. Merchant, consumer, LLM platform.
Makes sense. And quickly before we move to financials, there was an update on something called PayPal World about wallet interoperability.
Yes, a brief but important update. That initiative, which is all about making digital wallets from different countries work seamlessly across borders, is now officially in pilot stage.
Pilot stage. So first test transactions are happening.
Correct. It signals progress towards a future where global digital payments are even less fragmented, which obviously plays right into their strengths as a global connector.
Okay, let's circle back and nail down some of the financial details, particularly the PSP business payment service provider. That's the big enterprise processing arm, right? Often overlooked.
Very often overlooked, yeah. High volume, traditionally lower margin, but it looks like they've really turned a corner there.
How so?
PSP volume growth accelerated significantly. It hit 6% in Q3, which is a big jump from just 2% the previous quarter.
6%. And is it profitable growth?
That's what management stressed.
Yeah.
Yes, it's quality growth, contributing positively and reliably to overall transaction margin dollar growth now.
What changed? How did they fix the profitability there?
The strategy shifted from just being a basic processor to building deeper, more holistic relationships. They're focused on attaching high-margin value-added services, VAS.
Like what kind of services?
Things like global payouts, advanced fraud tools, sophisticated payment optimization engines, FX as a service, stuff that actually helps the merchant improve their own authorization rates or lower their costs.
Ah, so it's not just processing, it's adding real value that commands better margins.
Exactly. It makes the relationship stickier and more profitable for both sides. They expect that improvement to continue, and they're expanding unified enterprise solutions globally, like launching with Verifone for omnichannel in Q4.
Looking at the overall Q3 numbers then, transaction revenue grew 6%, hitting $7.5 billion, but the other value-added services revenue grew much faster, up 15%. Why the big gap?
That 15% VAS growth is a direct result of what we just talked about, successfully attaching those higher margin services. Plus, they saw strong performance in their consumer and merchant credit products as well. That faster VAS growth really helped the overall picture.
Okay. I did see the overall transaction take rate dip slightly, though, down 3 basis points to 1.64%. Is that competitive pressure forcing prices down?
Management indicated it wasn't primarily pricing pressure. It was mostly driven by mix effects,
Mix.
meaning a higher proportion of volume coming from channels or customer types that naturally have lower take rates.
Right.
Think large enterprise merchants who negotiate lower rates, or maybe certain types of BNPL volume.
Got it. So even though the average rate dipped slightly, the overall profitability improved.
Yes, because the quality of the volume improved. Despite the slight take rate dip, transaction margin dollars excluding interest still grew a healthy 7%. That confirms the underlying profitability trend is positive.
And I think that 7% growth even had a specific headwind in it during Q3, something about transaction losses.
That's right. Good catch. The reported 7% growth actually included a 1.5 percentage point headwind from higher loss provisions. This was tied to a specific temporary service disruption they had in Germany back in August.
So if you normalize for that one-off event,
The underlying transaction margin dollar growth was actually stronger, closer to 8.5%. And importantly, they confirmed that aside from that German issue, the underlying structural loss rates continued to improve quarter over quarter.
okay, so let's talk guidance. Full year looks strong. EPS raised, 16% growth. But the Q4 outlook, especially for transaction margin dollars, seemed a bit more cautious. Growing maybe 5% versus the 7% year-to-date. Why the slowdown in Q4?
There are a few factors, and it seems mostly like a conscious strategic choice rather than just macro weakness, though that plays a part.
What are the factors?
Okay, first, they have tougher comparisons in the credit business. The super low loss rates they saw previously are normalizing, which impacts year-over-year growth.
Makes sense. Credit cycles turn.
Second, yes, there's some macro caution. They mentioned seeing transaction volumes hold up reasonably well into October, but average order values or basket sizes are shrinking, particularly in retail. People are being a bit more careful.
Right. Spending, but maybe smaller amounts.
Exactly. But the third factor, and probably the biggest driver of the Q4 margin guidance, is a planned increase in investments.
Investing more. In what?
They're deliberately choosing to spend more in Q4 on specific initiatives designed to fuel growth into 2026. Things like driving product attachment, brand campaigns, offering more cash back incentives, securing better placement for their buttons.
So spending money now to lock in future growth, even if it dings margins slightly in the short term.
That seems to be the calculation. These investments act as a near-term headwind to how fast transaction margin dollars grow this quarter, but they're betting it will pay off next year and beyond by helping them win those generational shifts we talked about.
Okay, that makes sense. So summing up, it really feels like a company that's decisively shifted gears. From stabilizing the ship to hitting the accelerator, we've covered the core platform getting healthier, Venmo and BNPL really starting to fire as monetization engines, and this big strategic bet on agentic commerce.
That's a great summary. The narrative is completely shifted. It's no longer just about fixing things. It's about actively investing to win the future digital wallets, BNPL, and AI-driven commerce. They've shown the strategy can work, especially that flywheel effect in the US. Now the challenge is scaling it globally and making sure they own that next wave of commerce. And that brings us to the final thought for you, the listener. This shift to agentic commerce, it's not trivial. It means the very way you find products, how you decide what to buy, and how the purchase actually happens is set to change fundamentally. Now, given that this company is positioning itself to be that essential, trusted layer between all the merchants you buy from and these emerging AI platforms, think about this. How quickly do you really see your own shopping habits moving away from browsing websites yourself and towards relying on AI agents? And what does that potential shift mean for your loyalty to specific brands or even the visibility of those brands when an AI is doing the choosing?
Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.